all central banks are virtually inflationary by design and choice.
But very safe government bonds are no longer safe. If you hold government bonds, you're going to be losing money.
The bond market is the greatest bubble. Pensions in the UK have had to sell off assets, and they're paying at the moment a 7.75% negative return. So, do you want to buy an asset like that? No, I don't.
The United States doesn't seem to be under the same pressure as Britain or as Japan.
You're saving yourself for now at the cost of your Western allies, but what visits them will visit you in due course. They want to wipe the table clean, and they seek to start again.
Good evening. Welcome to NTD's Fresh Look America. I'm Paul Graney. Francis Hunt is a chartered market analyst with over 30 years of successful trading experience. He's an expert on global markets. Hunt is the founder of the HFV method of trading, which he teaches through his company, themarketsniper.com. So Francis, it's great to see you. Thanks for coming on.
Thank you for the invitation. Glad to be here.
So Francis, the chaos that we're seeing in financial markets like in Britain and Japan, why should it concern Americans, and is it perhaps a prelude to something we may see here in the future?
Absolutely. I think that's an excellent question. And it's amazing how we get prepared for things in our home country by seeing microcosms of similar contagion-based events in other nation states. And I would say, as I refer in the global village, unfortunately, there isn't a great variance between every nation state. They've all become hyper-indebted. They've all got very similar malaise. I've referred to the leper colony concept, where to be part of this global village as a nation state, you seem to be compelled to follow the proliferation of fiat strategies, the property boom cycles, and the subsequent bust. So we don't really get too much sound money being pursued in any single nation state. You wouldn't say that's a Mises country and point to any particular country.
Well, I think there are lots of people like yourself and others who've been warning about these improper practices in finance and in banking and in government borrowing and government spending for many years now. But I think for a lot of people, the monetary system, the banking system is not super interesting. It goes over their head. It doesn't really bother them day to day. But one thing that does is people's pensions. And we see in the UK recently, over the past week or two, the pensions there have come under serious pressure because of particular decisions by the central bank and the government. Can you explain what's happening there with people's retirement money?
So what you've had is pensions in the UK have had to sell off assets. They will have equities as well. They're not exclusive bond investors, but they are large bond investors because they have to pay in monthly amounts and they receive interest streams. So what's now happening is they're actually at a cash shortfall and they need to liquidate assets that should be retained. It's almost like selling the house. You're getting a rental stream, but now you can't pay what you committed to from those rental streams. So now you're having to sell the house. That's also killing the future rental stream. But that's how dire it has become. So you're going off selling your property portfolio to meet these requirements. And in the same way, housing has been hypervalued. The bond market is the greatest bubble because of the proliferation. So what's happening is nobody wants to buy debt in the UK. They had a 10.1 interest, CPI number, and they're paying at the moment 2.25 at their central bank rate. That means you are compounding, and in terms of real terms, a 7.75% negative return. So do you want to buy an asset like that? No, I don't. Do pension funds want to buy more when they're already up to the gills? No, they don't. So they now become forced sellers to meet short-term cash requirements, and then there was no bid.
I think this is a key point because even here in the States, our pension funds, they hold a lot of U.S. debt, U.S. government debt, treasuries, a massive amount. And I think up until now, we were told, okay, give us your whatever, a certain amount of your wage every month and we'll invest it well for you and we'll keep it safe. And when you retire, we'll give it back to you, perhaps with interest. A part of that safety was investing in secure government bonds. They were supposed to be the gilded standard in Britain, like you say, and kind of as we have similar security here in America with our U.S. Treasury bonds. But you're saying that because of inflation, that these investments are no longer safe. They're no longer good. People don't want to hold them anymore, and there's been a fire sale. The pension funds are trying to sell them off because the inflation has really killed the value. Is that correct?
Very much so. An interesting analogy that I'd sometimes give, if you were a privateer who were making rubber shoes, for example, in pink, something similar, say, to a croc, and you had a huge inventory, and you said each pair is worth $100. But right now in the market, you can't sell them for 5 or 10. It's so 1980s, it's so early 90s. You maintain that you are not bankrupt or insolvent because you value your current assets in inventory of these million pairs of pink rubber shoes that you have that you continue to assert are worth $100. And what happens is you only offer them for sale in the market for $100, but nobody is buying. Technically, this is the situation you have in Japan, because you were talking both about Britain and Japan. And what makes Japan even more extreme than the UK is that there's no bid markets and there's no volume trading. So it's almost like nobody, the bankrupt owner who is maintaining this hyperinflated current asset that is his inventory of stock continues to assert they're worth $100, but not a single member of the public wants to buy a pair of pink rubber shoes for $100. They wouldn't pay $5 for them. But you can't allow it to sell for that because that single mark trading at any volume at a lower price would reval your entire portfolio and assert and immediately make clear that you are in fact trading in an insolvent state.
Francis, can you talk about the difficulties facing the central bank and the government in Britain? What exactly is the decision they have to make here, and what is their thought process?
Essentially, if the Bank of England pulls out of, as it's threatened to, holding a bid under the bond market, that will cause pure panic. And that will cause a dump. And if we get that revaluation, I refer you back to my crazy entrepreneurs making pink rubber shoes, suddenly he's trading insolvent. If he finally decides he has to sell a pair to get some cash flow and he only gets $10, his valuation of 100 no longer is the mark to market for that asset. It's now 1/10. And as a result, he's bankrupt. So I think they're threatening that, but I think that's a paper tiger. They're going to be forced because the alternative is worse. In other words, I see a sustained, ongoing support in the debt market by the Bank of England, which is going to support an overinflated debt market so that pension funds can escape, but be very damaging to the pound. The other release valve when you have these malfeasant economic activities that do not allow true price discovery is then the currency. So what you then get is a further devaluation in the currency. More people that have American bank accounts will move them to the US, get a better rate, have more confidence in the bank potentially on the basis that it's a bigger domino and it'll be later to fall. So people are now just reacting. They're not strategic. They're not going straight to gold. We're not seeing that. Well, we've seen a massive increase. We've seen 400% actually in physical gold in certain broker reports. So there is some going there. But many people are very digitized. So they will flow from, it's like jumping on a stepping stone that's sinking. They'll just jump to the next stepping stone, which in due course will start to sink too. The long-term solution is you almost need to de-digitize during this era. You need physical assets that you hold and control. This is the day for the sovereign man. It truly is.
But why is it then that the Federal Reserve in the United States doesn't seem to be under the same pressure as Britain or as Japan?
So by being the world's major currency and by being the first to tighten and the hardest tightener, what they do is postpone the pain on themselves and export the inflation to the UK. So when you push the dollar up by being aggressive on interest rate policies, you actually bring the price of oil somewhat down because they are inverse correlated. So that actually reduces the inflation on what I almost teasingly refer to the Rockefeller tax that's in everything that you do, that is oil. So that brings the inflation down. But what it does is the dollar goes up higher. In the pound, oil price has actually gone up because the dollar is beating the pound and a lot of British money is now flowing away and out. So they actually get more of the inflation. So this is an everyone for themselves, and the biggest man gets to steal the most lunch in the beginning before everybody starves. And the US represents that. So you're saving yourself for now at the cost of your Western allies, but what visits them will visit you in due course.
While listening to you, Francis, I can't help but feel that inflation has really been the fundamental cause, at least the final straw that broke the camel's back here. Because even, like you said, very safe government bonds are no longer safe. People, they're negatively yielding. If you hold government bonds, you're going to be losing money. This is an incredible situation. And what it makes me think is, why were governments and central banks not more careful to not cause this incredibly high inflation around the world? Because when we think of inflation, nobody wants to pay extra for food or for gas or for anything like this. But it could bring down the entire global financial system from what you're saying.
So it's such a key point and such an excellent question. So here's what inflation does. All central banks are virtually inflationary, in my opinion, and by design and choice. Secondly, who benefits from inflation? The billionaire class that borrows big on low interest gets to secure income-producing assets and becomes further wealthy. Middle class and working class are destroyed by inflation. So who benefits? Always ask who benefits. Someone who's borrowed a ridiculous amount of money with very low fixed rates that were borrowed. I mean, when we were at the bottom of subprime, they weren't lending to SMEs, but corporates, many damaged corporates were borrowing huge amounts, some of which to pay dividends in the States. So when you're a big, juicy corporate, you get to borrow cheap and you get to borrow big. People that have large amounts of debt, that debt is devaluing at a chronic pace. You're on the right side of -7.25%. And by the way, that's off government statistics, which are being questioned by the likes of Shadow Stats immensely, the true inflation rate, according to Reagan's model way back in '82. If you look at that, I think the States are at about 18%. So actually, if I could borrow $1 billion at 2 or 3 years ago for a nominal rate of 3%, which would have been 2.5 above, and I could fix that, and I could go out buying land, farms, other things that provide food, highly useful physical aspects that we're all going to need in a supply chain collapsing environment. And I could have done that. That debt is already devalued immensely. I could have had 2 years of -18% compounded. That's virtually half. Yet the assets are being drilled up. If I bought oil fields, the price is going higher on a dominant dollar. So the billionaire class are going to make out like bandits, if you'll excuse the phrase. The problem comes for my apologies, the billionaire class. The problem comes for the middle and the lower income classes, who are the working poor. There's nothing good. And their percentage of income dedicated to the essentials is significantly higher. So inflation is a tax on the middle, the upper middle, and the working class. And it is an absolute tool of enrichment for the billionaire class or the privileged classes that get to borrow cheap, devalue their debt in that inflationary environment, and secure income-producing assets at the same time, because one gets valued down and the other one just becomes ever more worthwhile, and you capture the broadening of that spread out.
Well, that's interesting. So you say there's a perverse incentive for people to borrow money to get themselves into debt. They can use it to buy physical things, like you said, land or an oil field or whatever. They know that their debt is going to be devalued as inflation rises. But the interesting thing is, the more they do it, the more inflation will rise, because there's new money being created by the banks, right? This is expanding the money supply every time these uber rich borrow the money. It's increasing inflation. So it's this perverse cycle.
Yes, and I would just want to say, you borrow. I'm referring to that super class that can get preferential rates. Don't, as a retail observer of this program, go on your credit card where you're paying 18, 27, and 30% and go borrow big on that basis, because it's going to be a very difficult compounding rate to surpass in the normal asset and income producing category. So it's a great privilege as mega corporates to be charged to be loaned massive amounts. So banks get to grow their loan book on a much bigger scale. They don't need to see 10 grand loans to 20 different SMEs. They can just out 200,000 to a much bigger, or add a few zeros to that. If they're talking to GM, for example, they can extend an overdraft for 10 billion. to loan that amount of money on an SME book would require so many people in so many branches doing 100,000 here, 150,000 there. It's much more work for them. So the temptation is they lend to big established customers at low rates, and there is an implicit too big to fail in all of that. Remember AIG, that was the toxic bank during the great financial crisis. When Goldman Sachs realized that they were losing, they were on the wrong side of the Big Short, for those that watched the movie, they laid that risk off and insured against it with AIG. And every other investment bank laid it off and then lobbied government to make AIG whole, because they needed that business to be supported and held up so that they got paid out for their losses that they'd accumulated on their own book. So they passed the parcel, and it wasn't a very nice parcel, to the corner of the room, to the dumbest kid in the dunce hat, and said, don't let him fail. And in essence, that's been the lending environment. It's much easier to build loan book to big established corporates that have an implicit too big to fail license behind them than working with retail guys that hit the wall. We have capitalism for the middle class, certainly the bad aspects like bankruptcies, failures, credit destroyed, etc. But we get bailouts for the super billionaire and mega corporate class. And that's the big difference. There's a two-tiered economy where you face the downside of the capitalistic cycle as a retail middle class person or working poor. The corporations don't.
You've talked a little bit about central bank digital currencies, Francis. If we were to move into a central bank digital currency era, does this fix the problems that we're seeing here, the over-indebtedness, the low interest rates? Do we start from scratch?
I think there's going to be some form of debt jubilees. The key value is no one wants to start here. If you're a starting economy, you don't want to start with the existing IOUs all over the place. It's a mess and it's broken. So they're going to repeat the same cycle, and they're going to repeat a similar system, but it'll be a new generation that's going to have to learn this generation's lessons. But they want to wipe the table clean, and they seek to start again. So that is why I think the CBDCs come in. That's why I think wholesale debt jubilees will come in. That doesn't mean you on your credit card will get debt jubileed or on your mortgage. What it might mean is mega corporates face write-downs. The big danger is don't be on variable interest rates. Part of the dollar strength could be on a super spike of interest rates, where we see a collapse in the debt market. Remember, the inverse relationship of the collapse in the debt market, which is my big short, is actually a major change in rates. The yields go automatically up. That could really hurt over-leveraged everyday people. So that's why I feel debt jubilee and we reset and we start again. The CBDC part will just be a new, more technologically surveillance-orientated, manipulative and intrusive, with a whole new level of control dictometries that will come along with it. So I see this almost as a technological, oligarchical, call it a communism, where social scores will be introduced, how much meat you're consuming, all of these kind of dystopian, sounds like a conspiracy theory, a lot of those agendas. And this has come out of Bank of International Settlements themselves. This is not some wacko tinfoil hat comment. They have said in their own, Carstens has sat there and said, the great thing about a central bank digital control token, A, it's centralized, we control it, so it's not a crypto. And I think this puts crypto in a very difficult position because they don't like competitions to their money. And second of all, we can decline purchases. If there's inflation, we can do a wholesale cut in the total amount of money to reduce people's spending, so they can pass a haircut on everybody's CBDCs of 10%, 15% to stop you from spending, reduce the wealth effect if there's hyperinflation. And if it's a depression, they can give you a certain time frame orientated digital currency that you have to use by a certain time, that everyone will rush off and do a little shopping binge, and it will be valued for a certain time. So this is going to be a control board and mechanism. Think of a music studio with all the buttons and knobs for the central bankers to absolutely fine tune how much demand, how much supply, how much inflation, and the control and the data that it is going to bring and centralize on each and every consumer is draconian. And the biggest thing that people should be concerned about is privacy, intrusion, hyper-surveillance, and loss of freedoms. This is a very dangerous precedent.
You're saying it's purely the technology behind these CBDCs which will enable this?
It allows it. I mean, even in Bitcoin, if you can monitor address, you can see when money arrives, how much arrives. The blockchain has brought this, rather than how it was sold, this big privacy, the currency of kidnappers and people wanting to buy AK-47s. It's absolutely an open ledger. It's a global, in the cloud, internet-based open ledger. So this will make privacy tokens potentially more attractive if you are talking in the crypto space, but they represent a threat to a very powerful force of central bankers who want and seek to have explicit, overreaching control over their citizens. And I fear that is the big message that comes with the new system that's likely to be released as we are witnessing spontaneous events bringing down the existing system.
A lot to look forward to. The Market Sniper. Francis, thank you so much. Appreciate it.
Absolute pleasure. Thank you for having me on.